Let's look at two investors. First, we have the guy in your office who won't stop talking about his portfolio. He is a full-throttle day trader, deeply convinced artificial intelligence is the only thing that matters, and right now his aggressive bets on tech stocks are paying off. Then we have the second investor. This is the responsible adult. You don't pick individual stocks, you don't stare at charts all day, and you sleep soundly knowing your money is parked in a boring, highly diversified S&P 500 index fund. Despite these different approaches, the math inside both portfolios is nearly identical. Whether you are chasing the trend or buying the index, you have both placed your biggest bets on the exact same 7 tech stocks. Pull out your phone and open your retirement app. If your core holding is a Vanguard 500, a Fidelity 500, or a target date fund, look at your heaviest allocations. You are a massive shareholder in companies like Nvidia, Microsoft, and Apple, whether you chose them or not. The S&P 500 now functions as an aggressive, highly concentrated bet on the tech sector. What was designed to be a stable reflection of the entire U.S. economy is now dominated by the performance of a tiny group of companies. To understand how this happened, we need to look at the mechanics of the market. The S&P 500 has been hitting all-time highs, but that does not mean 500 different American companies are all thriving at the exact same time. The index operates on a system called market cap weighting. This means companies aren't treated equally. The larger a corporation's total value grows, the larger the percentage of your monthly investment it automatically swallows up. This chart shows exactly where your money is going inside the S&P 500 today. Because of market cap weighting, just 7 specific tech companies have ballooned to consume roughly 35% of the entire index. The speed of this change is what matters. In 2016, those same 7 companies accounted for only 12% of the index. That footprint has nearly tripled in less than a decade. The other 493 companies in the index have been pushed into a minority stake. When you buy the S&P 500 today, you are primarily buying a tech portfolio with a small collection of other industries attached to the side. Buying a standard index fund right now gives you the appearance of broad diversification, while actually tethering your financial future to the performance of a handful of Silicon Valley executives. Concentration only leads to catastrophe when the assets themselves are overpriced. We have to look at what it actually costs to own these 7 companies right now, compared to what they actually earn. This line graph tracks the stock market's price-to-earnings ratio, the metric economists use to measure the cost of the market, stretching from 1880 to today. The historical average is around 17. Today, we are sitting at nearly 40. To put a number of 40 in perspective, let's look at the environment right before the crash of 1929. Even at that historic peak, the market was mathematically cheaper than what you are buying into right now. In 145 years of recorded data, there is only one moment where this metric has ever been higher. That was December of 1999. Right before the dot-com bubble burst and erased roughly 80% of its value. Today, the total value of all public U.S. stocks combined has reached 231% of the entire underlying U.S. economy, the highest ratio ever recorded. The market is tolerating these record price tags based on a single assumption, that artificial intelligence is going to deliver an immediate wave of global economic productivity. This flowchart illustrates how that AI money actually moves. Hardware makers fund AI startups. Those startups sign massive contracts with cloud providers. Those cloud providers raise billions to buy more hardware. The biggest players in tech are effectively writing each other checks in a closed loop. But when that loop reaches the actual economy, the math changes. Recent data from MIT looked at real-world corporate AI deployments and found that 95% of organizations yield exactly 0 return on their AI investments. When 7 companies drive the majority of the market's gains, the entire index becomes a proxy for their success. If these multi-billion-dollar AI investments fail to generate real-world cash flow, the primary engine keeping your retirement account at these levels simply stops running. Record high prices for tech stocks require a flawless economic environment to support them. But right now, inflation is stubbornly high, and you can earn a risk-free return of 5% simply by lending money to the U.S. government. Beneath the surface, the credit markets are showing strain. Multiple peripheral lending companies have collapsed recently, taking hundreds of millions in bank losses with them. JP Morgan CEO Jamie Dimon recently warned that when you see one cockroach in the banking system, there are usually more. While everyday investors continue to pour money into these peak valuations through their 401ks, some of the most experienced investors in the world are doing the opposite. Several large-scale investors are moving to the sidelines. Warren Buffett recently amassed nearly $400 billion in cash, his highest reserve level in decades. When investors who have spent decades successfully navigating every major market cycle move to the sidelines at once, it is worth paying attention to the signal they're sending. The plan to just sell when things look bad ignores how we actually process financial loss. Historical market data shows that investors tend to buy more as prices rise in a state of euphoria, and then find themselves unable to act when a sudden drop triggers a panic response. This chart shows a mechanical fix, the equal weight S&P 500 fund. Instead of letting 7 tech giants dominate your portfolio, an equal weight fund forces the math to divide your money into 500 identical, uniform pieces. You can also look outward. International markets offer exposure to different economic cycles, and simple cash yields will currently pay you around 4% with zero risk. Don't rely on the appearance of safety. Log into your accounts today, check your real exposure, and adjust your portfolio's math while the market is still at all-time highs.